Kyivstar. It's a Ukrainian telecom and data services company which relies on SpaceX's Starlink terminals. On August 15th, Kyivlink became the first Ukrainian company to trade on the NASDAQ.
Imagine for a second that you are walking into a high-stakes boardroom on Wall Street.
Okay, setting the scene.
Yeah, like you've got your slide deck ready, your suit is pressed, and you're pitching this massive investment opportunity to some of the most, risk-averse financial minds on the planet.
Right, the classic corporate pitch.
Exactly. And usually in these meetings, the primary operational risks you have to defend against are things like inflation ticking up a tiny fraction of a percent.
Or, maybe a minor supply chain bottleneck somewhere. That's the baseline anxiety for these guys.
Right, that's what keeps them up at night. But your pitch today is entirely different.
Because it's a completely inverted risk profile.
Yeah.
You aren't talking about interest rates at all. You're talking about sheer survival.
Because in your pitch, you have to look these institutional investors right in the eye and explain that your primary operational risk is actual literal missile strikes on your physical infrastructure. Yeah, like how do you convince Wall Street that your company is a safe bet when your home country is in the middle of a full-scale, devastating war?
I mean, it sounds like an impossible premise.
Yep.
You are essentially asking them to underwrite a war zone.
Exactly.
And we know that investors traditionally, well, they run for the hills at the very first sign of geopolitical instability, let alone an active invasion dominating the news.
Capital is cowardly, right? That's the say.
Yeah, it seeks safety above all else, always.
Which is why the reality of this is just so staggering, because the pitch I just described, it wasn't some hypothetical stress test. It actually happened, and it succeeded.
It's pretty wild.
Welcome to today's deep dive. We are unpacking the really unprecedented story of Kyivstar.
Right, Ukraine's largest telecommunications provider.
Yep. And over the last few years, their journey has basically defied almost every conventional rule of business, finance, and logistics.
And their story is just so crucial for anyone interested in business strategy, because they didn't just manage to keep their cell network running through, the absolute darkest days of the Russian invasion.
Yeah, no, they went way beyond that.
Right. They achieved something genuinely historic in global finance.
In the middle of a war, they became the first Ukrainian company to ever IPO on the NASDAQ.
Which is just incredible to even think about.
So our mission today is to decode their playbook. We're going to explore how they pulled off this financial miracle, basically.
Yeah, and how they're aggressively transforming from a traditional phone company into this massive closed-loop super app ecosystem.
And what their journey teaches the rest of us about true corporate resilience, because it really changes everything.
It does. It's a blueprint that completely rewrites how we think about risk, adaptability, and, what it actually takes to keep an enterprise connected when the physical world around you is literally falling apart.
Right. So to really grasp the sheer scale of what Kyivstar has built, I think we have to start at the climax of their recent financial journey.
Stepping onto the NASDAQ stage in New York.
Exactly. This is during the 2025-2026 timeframe. Kyivstar, whose parent company VEON is also publicly listed, by the way, they successfully
KYIV.
Right. Now, I was reading through the transcripts from the 2026 Ukraine House in Davos, and the Rothschild advisor who actually worked on this deal gave an incredibly candid look behind the curtain.
Oh, I bet. What did he say?
So when the idea of a Kyivstar IPO was first floated internally, he actually put it in his Mission Impossible folder.
Naturally.
Yeah, he forwarded the email to his colleagues on Wall Street, and they literally printed it out, put it on the floor, and declared it the craziest email of the year.
And, I mean, if you put yourself in the shoes of a Wall Street analyst, you completely understand why.
Oh, for sure.
When you hear the phrase wartime IPO, your brain immediately assumes this is an act of total desperation.
Right, like a bailout.
Exactly. You assume it's a dying company, gasping for air, pleading for international cash, just to keep the lights on for one more month.
But the reality of the Kyivstar listing was the exact opposite, wasn't it? They weren't looking for a lifeline at all.
Not at all. The chairman of their board drew a very sharp line in the sand on this. He stated this was not a liquidity event, but rather a credibility event.
A credibility event. That is a fascinating pivot.
Yeah, and that distinction is basically the cornerstone of their entire strategy.
How so?
Well, a liquidity event means you're going public because you desperately need cash to survive, right?
Right, you're tapping the market for funds.
But a credibility event means you're going public to prove a point. You're stepping into the spotlight to establish absolute trust,
Oh, I see.
You're showing the global market that your operations are so transparent and fundamentally sound that you can withstand the rigorous scrutiny of the U.S. SEC, even while your headquarters are under threat.
So they were basically inviting audits, not asking for handouts.
Precisely. And the market recognized the difference. I mean, following the listing, the company's valuation didn't flump. It actually grew by 20%.
Which is insane. But that brings up the actual mechanics of how they listed, because they didn't do a traditional IPO, did they?
No, they used a SPAC.
Right, a special purpose acquisition company. Now, for those listening who might not be deep into financial structuring, SPACs are essentially blank check companies that are already listed on the stock exchange.
Right. They exist solely to merge with a private company and take it public faster than the traditional route.
Exactly. But SPACs have had a really brutal reputation lately, specifically because of something called the redemption rate.
Oh, yeah. The redemption rate is the ultimate stress test of a SPAC.
Break that down for us.
So when the blank check company finally announces who they are merging with, in this case, Kyivstar, the existing shareholders of that SPAC have a choice.
Okay.
They can either stay invested in the new combined entity, or they can say, I don't like this deal. I want my original cash back.
And historically, those shareholders bail, right? I mean, the data we look at shows a 90% shareholder redemption rate is perfectly normal for a SPAC.
Yeah, basically 90% of the people look at the final company and just pull the ripcord.
So Kyivstar takes this route, the craziest email of the year route, pitching a telecom in a war zone. But they saw 75% of those SPAC shareholders actually stay.
Which is unheard of.
They didn't cash out. That is a record-breaking retention rate. But this is where I really need to push back because it feels completely counterintuitive.
How so?
It's like applying for a commercial mortgage while your building is actively on fire, but somehow you're convincing the loan officer that the fire is a great reason to invest. Like, how on earth do you show reliable, predictable cash flow in a war zone?
You do it by forcing the investors to separate the geopolitical narrative from the balance sheet.
Okay, that sounds good in theory, but how?
Well, at Davos, the advisors broke this down into two very distinct concepts. Sympathy capital versus rational capital.
Okay, sympathy capital, that's essentially donation money, right?
Exactly. It's solidarity. It's investors or institutions saying, we feel terrible about what is happening. Here is some financial support.
Right.
And while that capital is noble and entirely necessary during a crisis, it is inherently temporary. It does not sustain a multi-billion-dollar corporate valuation over a decade.
Because eventually sympathy runs out. People move on to the next crisis in the news.
Precisely. Sympathy fatigue is a very real economic factor. Rational capital, on the other hand, is cold, analytical, and entirely performance-driven.
Ah, okay. So the institutional investors who kept their money in that SPAC didn't do it out of charity.
Not at all. They did it because they looked past the front-page headlines of blackouts and sirens, and they looked at the EBITDA.
The earnings.
Right. They saw a company with strong governance, transparent NASDAQ-level reporting, and cash flows that were actually trending upwards.
Wow.
As the Rothschild advisor noted, institutional investors are not completely risk-averse. They are risk-adjusted.
So if you can identify the risk, quantify it, and prove you have a mitigation strategy, Wall Street will buy in.
Exactly. They successfully shifted the investor conversation from, is Ukraine investable right now, to, is this specific telecom company properly priced, given its phenomenal performance metrics?
That's a huge psychological shift. But, you can only have that conversation if the underlying business is bulletproof. You cannot fake a balance sheet to the SEC.
Right, the numbers have to be real.
Which brings up a massive, glaring logistical hurdle. To show reliable cash flow to those rational capital investors, you have to have a product that actually works.
You certainly do.
You cannot have a successful IPO if your core product, the mobile network, is offline. If your customers are sitting in the dark and can't make a phone call, they aren't generating revenue.
No, they aren't.
So we have to look at the physical reality on the ground. How did they achieve this extreme infrastructure resilience?
Well, this is where the narrative shifts from, financial engineering in New York to hardcore physical engineering across Ukraine.
Because managing a national telecom grid is difficult in peacetime.
Doing it during a conflict requires a mobilization that mirrors a military logistics operation way more than a corporate maintenance schedule.
The sheer scale of their physical footprint is just daunting. We're talking about Kyivstar maintaining roughly 16,500 physical technical sites across the country.
It's massive.
And we know that the national power grid faced massive targeted disruptions. During the worst energy blackouts, there were times when 40 to 60% of Kyivstar's infrastructure in certain regions had zero electricity from the central grid.
Total blackouts in some areas.
Right, total blackouts. Yet, despite half their sites being completely cut off from municipal power, less than 10% of their network ever went down.
Which is just a miracle of engineering. Achieving that 90% uptime in those conditions requires a complete overhaul of how a telecom operates.
What did they actually have to do?
To keep those 16,500 sites alive, Kyivstar mobilized over 2,000 field engineers. To put that in perspective, the entire normal technical function for a telecom of that size in Ukraine is around 800 people.
So they more than doubled the workforce.
Yeah, they had to more than double it just to handle the emergency response and infrastructure triage.
And those engineers were essentially out there building a shadow power grid. The logistical numbers are almost hard to comprehend. I read they deployed 250,000 batteries across the network.
250,000 batteries.
And these aren't small backups. These are industrial units designed to provide 10 to 12 hours of protection for the last mile network just to keep the local towers broadcasting.
Right, and for the longer multi-day blackouts, they deployed 3,700 massive generators.
So it's basically a triple-layer security system. You have the municipal grid, then the battery banks kick in, and if those drain, the diesel generators fire up.
Exactly. But if we connect this to the broader economic picture, batteries and generators are fundamentally reactive solutions.
Right, you're just putting out fires, literally and figuratively.
Yes. You are still entirely dependent on external forces. You rely on complex fuel supply chains to keep those 3,700 generators running. And you rely on the municipal grid eventually turning back on to recharge those 250,000 batteries.
So you are just bleeding capital just to tread water at that point.
Which brings us to what I find to be one of their most brilliant, forward-thinking strategic moves, their solar-first strategy.
Oh man, and they are so aggressive about this. By early 2026, they had poured $115 million into energy resilience.
Huge investment.
In December 2025, they went out and bought a 13-megawatt solar power plant. And they aren't stopping there. They are currently building out a massive 104-megawatt Lviv cluster of solar parks, essentially buying up 6 more utility-scale plants.
It's an incredible scale.
But let me push back on this because it sounds completely outside their mandate. Is it normal for a telecom to essentially become its own decentralized power utility?
Normally.
Like, they are buying massive solar farms. To an outsider, that seems like an incredible distraction from their core business, which is selling mobile data and phone plans. Shouldn't they just be paying a utility company and focusing on telecom?
In a stable, peacetime environment, you would be absolutely right. It would be a massive capital distraction. But this highlights the essence of wartime adaptability.
Okay, how so?
In their specific environment, energy is the core business. Because without reliable energy, there is no data to sell.
That's a good point.
And more importantly, you have to look at the financial hedge this provides.
Right, because running those generators isn't cheap. We're looking at $17 million spent just on diesel in a single year. Plus, their baseline grid electricity costs jumped from $30 million in 2024 to $35 million in 2025.
The price per kilowatt hour spiked 18% in a single year.
And they were staring down another 10 to 15% projected increase for 2026.
Exactly. If they just relied on municipal grids and diesel, their profit margins would completely collapse under the weight of fuel inflation.
Ah, so it's a financial play.
Yes. That is why the $115 million investment into the Lviv solar cluster is not some environmental PR stunt. It is a brutal, calculated financial hedge.
Okay, that makes sense.
By owning their own power generation, which, by the way, will cover up to 40% of their total energy consumption, they are insulating their bottom line from extreme external energy market volatility.
So they are basically fixing their operating costs.
Exactly. So when diesel spikes or grid electricity jumps another 15%, Kyivstar's margins remain intact. That is exactly the kind of predictable, defensively positioned cash flow that rational capital on the NASDAQ demands.
That reframes it perfectly. They aren't just buying solar panels, they are buying financial predictability.
Precisely.
And speaking of extreme resilience, we have to talk about what happens when the physical cables on the ground are completely severed. Because terrestrial power is only half the battle, right?
Right. If the fiber optic cables are cut, the tower is useless, even if it has solar power.
Exactly. So Kyivstar became the first European provider to launch direct-to-cell, or D2C, satellite connectivity in partnership with SpaceX's Starlink.
Which is just a monumental technological leap for telecommunications.
Break down how that actually works, because historically, satellite internet required a localized ground station, right? Like a physical dish on your roof, to receive the signal from space and then distribute it to your devices via Wi-Fi.
Right. But direct-to-cell changes that entirely. The Starlink satellites in low Earth orbit essentially act as cell towers in space.
Okay.
They beam a connection directly to the standard LTE smartphone that's already sitting in your pocket. No extra hardware, no satellite dish required.
That is wild. The CEO of Kyivstar spoke about this extensively at the Davos panel. He mentioned visiting SpaceX in Florida at the end of 2024. Back then, SpaceX only had 60 of these specific D2C capable satellites in orbit. Now they have over 650.
Yeah, the rollout has been extremely fast.
And this technology isn't designed so you can, stream high-definition video in a bunker.
No, it's a lifeline.
Exactly. It is designed as the ultimate last resort safety net. During a total terrestrial blackout, when the towers are down and the fiber optics are cut, this direct satellite link keeps basic SMS text messaging alive.
And crucially, it keeps MasterCard payment terminals operational.
Right. Think about the societal implications of that. Imagine the rapid economic collapse if a city loses power and suddenly no one can buy food, water, or medical supplies because the digital payment infrastructure goes down with the cell towers.
Exactly. By bypassing the physical terrestrial network entirely and routing transactions through space, Kyivstar ensures that the absolute baseline of a functioning economy survives the worst-case scenarios.
It's no wonder over 3 million people registered for this specific service almost immediately after it launched.
It's the ultimate fail-safe.
So they secured the power grid, they secured the network from the ground all the way to outer space. They stabilized the core business.
But here's the pivot in their story that I find most fascinating.
Oh yeah, because once they achieved stability, they didn't just hunker down, play defense, and wait for the conflict to end.
No, they went on the offensive.
They went on an aggressive corporate shopping spree. They operate under a philosophy they actually call strategic optimism.
And strategic optimism is a very specific psychological and corporate posture.
Tell me more about that.
It's the institutional belief that despite a grim, terrifying, and chaotic current reality, you will eventually prevail. And if you fundamentally believe you are going to prevail, you don't just plan for mere survival. You actively plan for market dominance in the post-war landscape.
You build the future while the present is still uncertain.
Exactly.
And they have a massive war chest to execute this vision. Backed by a $1 billion investment pledge over 5 years from their parent company, VEON, Kyivstar is actively transitioning away from being just a traditional telecom.
Right. They want to be much more than that.
Yes, they hold a massive, dominant 47% market share in mobile coverage. That puts them way ahead of competitors like Vodafone at 32% and LifeCell at 21%. But they don't just want to sell you a data plan anymore.
Yeah.
They are transforming into a digital service provider. They are building an entire digital ecosystem, what the tech industry calls a super app.
And to understand why a telecom would want to become a super app, we have to look at the unit economics.
Okay, let's look at the numbers.
The key metric in this industry is ARPU, average revenue per user. For a standard mobile user who just buys a basic talk and data plan, Kyivstar brings in about $3.80 per month.
Okay, pretty standard.
But if they can convert that person into a multi-play user, someone who uses their mobile data plus their home internet, plus their bundled digital apps like Kyivstar TV or their health services, that monthly revenue jumps to $5.20 per user.
Which is a huge jump. Like, think about your own cell phone bill for a second. If your provider can get you to seamlessly integrate their proprietary apps into your daily life, your value as a customer skyrockets.
Moving millions of users from 380 to 520 is a massive leap in profitability, and they do it without having to acquire a single new subscriber.
So how do you get people into that ecosystem? You just buy the apps they already rely on.
Right.
Let's look at how they tackled the mobility and logistics sector. In April 2025, Kyivstar acquired Uklon for $155 million.
Yep.
Now, Uklon is essentially the Ukrainian Uber. It has 3.8 million active users and generates $100 million in revenue.
And Uklon's corporate history is actually a perfect micro case study in this exact kind of David versus Goliath resilience.
How so?
Well, Uklon started back in 2010 and built a de facto monopoly in the Ukrainian ride-hailing market. But around 2016, massive global giants with deep pockets like Uber and Bolt entered the market.
Ah, the venture capital invasion.
Exactly. And as you would expect, Uklon's market share was decimated, plummeting from 90% down to roughly 25% by 2021. They were systematically getting squeezed out.
Which is the classic Silicon Valley playbook, right? Burn billions in venture capital to subsidize rides and starve the local guy out of business.
Right.
But a full-scale invasion fundamentally breaks that model. The international competition suddenly had to try and manage a chaotic, dangerous war zone from comfortable, air-conditioned boardrooms in San Francisco or Estonia.
And they were shocked. They pulled back.
But Uklon, the local team, they dug in. They proved their resilience, adapted their management structure for times of war, and bounced back to reclaim the market.
And their financials today are almost unbelievable. Uklon boasts a 28% EBITDA margin.
That's their profit margin before interest, taxes, depreciation, and amortization, right?
Exactly, 28%.
Right.
When you look at the broader global market, a giant like Uber sits at around a 12% margin, and Bolt is down around 5%.
But this raises an important analytical question, and I was wondering this myself. Did the war simply clear the field of international competition, allowing Uklon to win by default? Like, did Uber just abandon the market, leaving a vacuum? Or is there something structurally different about how this company operates now that it's under the Kyivstar umbrella?
It's much deeper than simply winning by default. It comes down to integration and a metric called customer acquisition cost, or CAC.
Ah, okay, explain that.
When a standalone tech startup like Bolt or Uber wants to win a new user in a new city, they have to spend heavily on marketing, and ride discounts to convince you to download their app. But now that Uklon is fully owned by Kyivstar, they don't have to spend a dime on acquisition. Kyivstar already has 23 million loyal captive mobile subscribers.
Oh, wow, I see where this is going.
They can seamlessly market Uklon directly to those users via zero-cost push notifications. They can bundle ride credits into premium data plans, or they can allow users to pay for their taxi with their Kyivstar mobile balance.
The cost to acquire a new rider drops to basically zero.
Exactly. Which is exactly why Uklon's profit margins are more than double Uber's global average.
And they aren't just resting on ride-hailing, they are actively adapting to the wartime reality of logistics. With domestic railway systems constantly under threat of attack and commercial airports entirely closed to civilian traffic, how do people actually move around the country or evacuate into Europe?
Buses.
Exactly, buses. Intercity buses have become the primary artery for domestic travel. So, identifying the shift, they launched Uklon Travel in March 2026. This allows users to buy intercity bus tickets right inside the app.
It's a brilliant, seamless UX.
Right. You need a ride to the bus station, order a Uklon car. You need the actual bus ticket, buy it on Uklon Travel. They even introduced a hyper-local feature called Car Help, where if your battery dies, you can order a driver to come jumpstart your car for 180 hryvnia.
So they have built a true, all-encompassing super app for mobility. They've completely locked down how people move around the country.
They've solved the physical logistics layer.
But a super app operating in a war zone cannot just be about convenience and taxis. It has to address fundamental survival.
Yes.
And that leads us to how they applied this exact same closed-loop logic to something far more critical, the national health infrastructure.
Okay, the healthcare play is what truly blew me away when researching this, because they have essentially built a parallel digital state infrastructure.
Yeah, it's massive.
It starts with a platform called Helsi. After the Russian invasion, Kyivstar rapidly increased its existing stake and now owns 98% of the company. And to put this in perspective, Helsi isn't just a niche fitness app for a few early adopters.
They're from it.
It has an absolutely staggering 28 million registered users.
Which is effectively the entire adult population of the country running their healthcare through one corporate ecosystem.
It is used by 42,000 doctors and is actively deployed in 70 to 80% of all hospitals and clinics in Ukraine.
Helsi has a really interesting origin story, actually. It was originally created back in 2016 as a private IP solution, eventually a simple registry to help doctors modernize and digitize their scheduling.
Okay.
But over the years, and especially under the pressure of the conflict, it evolved into the de facto public health infrastructure for the entire nation. It is the primary gateway. You use it to book appointments, choose a primary care physician, and access your national e-health records.
And under Kyivstar's ownership, they have turned this massive user base into a significant profit center. They paid about $26 million for their controlling stake, and they are now generating highly profitable revenue streams. They introduced premium tiers like Helsi Plus, which saw user growth of 283% year over year.
But here is where the closed-loop synergy you mentioned really takes form. In early 2026, Kyivstar made another massive acquisition in the medical space, Tabletki.ua. They bought it for $160 million.
Wow, so they just throw money around. But wait, what exactly is Tabletki?
So Tabletki is the absolute dominant online marketplace for medicines in Ukraine. They have an incredible 14,000 individual pharmacies connected directly to their platform.
Oh, wow.
And the financials on Tabletki are phenomenal. They were already seeing 30% year-over-year growth before Kyivstar even acquired them, and they are projecting an estimated $32 million in EBITDA for 2026.
So let's put this all together and visualize it. Imagine you are a patient in Ukraine. You wake up feeling sick. You open the Helsi app on your phone, a phone that is connected to Kyivstar's solar-powered, satellite-backed, hyper-resilient network.
Right.
You conduct a secure telehealth video consultation with a doctor directly through Helsi. The doctor issues you an e-prescription.
Okay, I see where this is going.
Without ever leaving the Kyivstar app ecosystem, you use the newly integrated Tabletki feature to instantly price-check that exact medication across all local pharmacies in your neighborhood. You purchase it, and then you click one more button to have a Uklon driver pick it up and deliver it right to your front door.
What is truly fascinating at the systemic level is that they have privatized, digitized, and streamlined the entire societal function of healthcare and logistics into a single, seamless, highly profitable user journey.
Yeah, they aren't just selling consumer convenience, they are providing absolute critical stability to the population.
And they are applying this exact same playbook to the government and corporate enterprise sector as well. They are currently pushing to acquire 80% of GigaCloud for around $12 to $15 million.
What's GigaCloud?
It's a major
Якщо
cloud
потрібно
hosting
провести
provider.
якісь
And who
оголошення,
they host the public
запланувати
procurement system
події,
for Zoro,
собі
alongside
поставити
major
нагадування,
corporate clients.
в системі
Kyivstar
є
isn't
відповідний
just the phone
інтерфейс.
company
Якщо це
anymore. They
дуже
are
щось
literally
важливе,
becoming
відмітити,
the
що це
digital
тривога,
backbone of the nation's governance and healthcare.
They really are. But, we have to pause here because we cannot lose sight of the broader context.
What do you mean?
Well, we have spent the last half hour discussing EBITDA margins, SPAC retentions, customer acquisition costs, and super app integrations. It paints a picture of aggressive, highly successful corporate strategy. But we must ground this analysis in the very real, very grim realities that make this hyper-resilience necessary in the first place.
Yeah, that's incredibly important.
The strategic risks Kyivstar faces daily are not abstract market forces. They are existential threats.
The human cost is incredibly sobering, and we have to acknowledge it. We are talking about a company operating under daily lethal threat. The records explicitly state that 250 Kyivstar employees have been mobilized into the armed forces to fight.
And tragically, 20 employees have been killed by Russian attacks, with others listed as missing or currently in captivity.
Right. This isn't a theoretical Harvard Business School case study about optimizing supply chains. These are real people risking their lives, climbing towers in the dark to keep the network alive for their fellow citizens.
And this brutal geopolitical reality forces the company's leadership to make massive, highly expensive strategic shifts regarding their infrastructure. Take their core network hardware, for example.
Okay.
Prior to the invasion, Kyivstar's network was heavily dependent, up to 70% in some areas, on Chinese hardware, specifically from high-risk telecom vendors like Huawei and ZTE.
Right, and we know there has been a massive global push, especially driven by the US and the EU, to completely remove Chinese technology from critical national infrastructure due to severe espionage and cybersecurity concerns.
Exactly. You cannot integrate yourself into the European digital economy if your core network is vulnerable to hostile state actors.
So what did they do?
Kyivstar initiated a sweeping Europe-first equipment sourcing strategy. They are actively executing a massive rip-and-replace operation. They're systematically pulling out the Chinese hardware and replacing it top to bottom with European technology from Nokia and Ericsson.
That's a massive undertaking.
Yeah, they are doing this for their existing core network and their entire future 5G rollout. As their internal presentations note, this strategy means higher prices, less risk.
They are voluntarily taking on significantly higher capital expenditures to fully align their network with stringent EU cybersecurity standards.
And speaking of navigating complex geopolitics, we have to address the corporate elephant in the room regarding their ownership structure.
Ah, yes. The let-alone issue.
Right. If you dig past the VEON parent company and look at Kyivstar's ultimate ownership, you find a major international investment holding company called Letaron. Letaron owns a 45.5% stake.
Now, the issue is that Letaron was co-founded by Mikhail Fridman and Peter Avin, who are prominent Russian-Israeli billionaires. And both of those men were heavily sanctioned by the EU and the UK in early 2022 following the full-scale invasion.
And this is a critical governance vulnerability that could easily derail an IPO or freeze international investment if it is not managed perfectly.
Oh, totally.
When your ultimate beneficial owners are sanctioned by Western governments, the radioactive fallout can instantly freeze a company's bank accounts, halt their operations, and make them completely uninvestable.
So how did Kyivstar survive that massive liability while trying to list on the NASDAQ? The governance documents explain that Letaron's corporate structure was aggressively reorganized to completely isolate Kyivstar and VEON from the founders.
Right, they had to build a wall.
Yeah. Fridman and Avin's voting rights were stripped and reduced to absolute 0%. The entity is now managed by a fully independent European and British board of directors. They built an impenetrable legal and financial firewall to ensure the sanctioned individuals have zero operational control and draw zero financial benefit from the company.
They had to make Kyivstar pristine for Western capital. You can actually see this reflected in their own board of directors for the Kyivstar Group, which recently brought on heavy hitters like former U.S. Secretary of State Mike Pompeo.
They are very deliberately wrapping themselves in the Western security and corporate establishment to project absolute stability.
Which brings us to one final, highly counterintuitive strategic move that perfectly illustrates how wartime realities invert traditional business logic. It involved their physical towers.
Okay, lay it on me.
We established earlier that Kyivstar's biggest physical asset is its sprawling infrastructure of 8,000 radio towers and 7,000 additional antennas. These structures cost between $50,000 and $100,000 each to build.
And that doesn't even include the massive wartime additions like the battery banks and generators we discussed.
Exactly. But the findings reveal they are entering into a massive joint venture with their biggest industry rival, Vodafone Ukraine, to consolidate and share a combined footprint of over 25,000 sites.
Okay, hold on. I need to push back on this again
Yeah.
because from a traditional business perspective, this sounds like corporate suicide.
How so?
If you are Kyivstar and you have spent billions building the best network, you have the most towers, and you hold a dominant 47% market share. Why on earth would you voluntarily share your biggest physical asset with your primary competitor? Doesn't that completely destroy your competitive moat? If Vodafone can just rent space on your hard-earned towers, you lose your biggest coverage advantage. Are the fundamental rules of capitalism just entirely rewritten in a war zone?
In a word, yes. The rules change because the definition of efficiency and risk fundamentally changes. In peacetime, a vast, proprietary tower network is indeed a massive competitive moat. In wartime, a proprietary tower network is a massive, highly exposed liability that requires constant, expensive repair from physical destruction.
That makes sense.
The internal presentations note that roughly 5% of their entire network has been physically destroyed or heavily damaged by strikes.
5% of 16,500 sites. That's hundreds of towers reduced to scrap metal.
Exactly. It's a staggering capital loss. So, by creating this joint venture and sharing towers, they achieve two critical objectives. First, sheer financial efficiency.
How does that work?
In Europe, operator-owned towers usually have a tenancy rate of about 1.2, meaning mostly just the parent company uses it. Independent shared tower companies have a tenancy rate of over 2.2, meaning multiple carriers rent space on the exact same structure.
Ah, I see.
By sharing towers with Vodafone, they split the land lease costs, they have the maintenance costs, and crucially, they share the massive financial burden of deploying those expensive batteries and generators to every single site.
Right. So instead of Kyivstar and Vodafone both building a $100,000 tower right next to each other on the same hill and both spending $20,000 outfitting them with independent battery banks.
They build one fortified tower and
Right.
split the bill.
Exactly.
It is capital preservation. But the second, and arguably more important reason, is national redundancy. If a Kyivstar tower gets blown up, but there is a shared Vodafone tower functioning a mile away, The network can heal itself and reroute traffic much faster.
Wow.
In a war zone, national redundancy and collective resilience absolutely override traditional, isolated competitive strategies.
Yeah.
As their strategy slide explicitly notes, this joint venture covers coverage gaps, boosts capital efficiency, and increases resilience for the entire country.
So the competitive moat is no longer, I have more physical steel in the ground than you. The competitive moat becomes the digital ecosystem, the Helsi app, the Uklon integration, Kyivstar TV that rides on top of that shared physical network.
Exactly. It is a masterclass in strategic adaptation. They assessed their environment, recognized what was a liability, and completely restructured their business model to survive it.
So, bringing this entire deep dive full circle, we started by imagining a pitch to Wall Street, trying to convince risk-averse bankers to invest in a company operating under the daily threat of missile fire. The story of Kyivstar, of this historic NASDAQ IPO, is definitive proof that rational capital and extreme physical hyper-resilience can absolutely coexist.
They didn't walk into New York asking for sympathy or charity. They proved their worth on the balance sheet.
Right. By investing hundreds of millions in physical power generation, like solar farms, launching cutting-edge satellite backups with SpaceX, and aggressively acquiring healthcare and transport apps to build an inescapable closed-loop digital ecosystem, Kyivstar turned the ultimate adversity into unprecedented corporate growth.
They systematically decoupled their financial success from the immediate physical destruction around them by creating digital value and absolute energy independence.
Which leaves us with a final, lingering question to mull over as we wrap up today. If a company in Ukraine can build a highly profitable, self-sustaining, solar-powered digital super app and ecosystem that encompasses the nation's healthcare, its physical transport, and its core telecommunications, all while operating literally under missile fire and dealing with rolling blackouts.
Yeah, what is the excuse for legacy corporations in peacetime?
Exactly. You know the ones. The companies who sit in comfortable air-conditioned boardrooms and confidently claim that adapting to new technology is too difficult or that changing their business model is too risky. Will the ultimate blueprint for 21st century corporate resilience be written not in the cushy offices of Silicon Valley, but in the crucible of a war zone?
Because suddenly, pointing at an X-ray of a minor supply chain delay or a tiny inflation bump and saying it's too hard to adapt just doesn't cut it anymore.
Not when you compare it to what is demonstrably possible when a company is truly pushed to its limits.
Exactly. It completely changes the standard for what a resilient business looks like.
It really does. Thanks for joining us on this deep dive into Kyivstar. Keep questioning the baseline, and we'll catch you next time.